In this video, we'll discuss and demonstrate a concept called dollar value LIFO. Now, this is a rather technical concept, and also the calculations can get technical, so I advise you to kind of buckle your seatbelts and really pay attention as we go through. In order to get to understand dollar value LIFO, it's actually important to go back and just think a little bit about what the LIFO cost flow assumption is saying. So LIFO, and I'm on page 5 of your handout, LIFO assumes that the last goods purchased are the first used or sold, which then also means that the inventory remaining at the end of the year must represent the oldest purchases. So if you think about this carefully, what we're trying to say is that with LIFO, your ending inventory is always the oldest items. And if we are assuming inflation, which we can because generally we have inflation and not deflation, so if prices are increasing as time goes by, that older inventory also has a lower price. And why it's important to focus on this idea of LIFO, assuming that the oldest inventory is left behind, is that sometimes companies run into a problem known as LIFO liquidation. So liquidation means that something was sold, right? So something was gotten rid of. And what this LIFO liquidation means is that sometimes a company sells or liquidates the old inventory which it has on the books. Now, this may sound like a good thing, but it's actually not a good thing. The reason this is not a good thing is that that old inventory is at a much lower cost than the newer inventory. And as such, the company will actually have a lower cost of goods sold when it liquidates old inventory than it would have had if it was selling later units. And sometimes this results, not actually sometimes, if this happens, the company can be faced with major tax payments because the cost of goods sold is so low. So let's think this through again, right? A company using LIFO assumes that the oldest and the cheapest units are left over in ending inventory. If the company sells many units during the year and doesn't buy enough later units, it could result in a liquidation, right? So the older units are actually assumed to be sold. What then happens is that the company has a lower cost of goods sold number than it would have had if it didn't have this liquidation take place. Because of that lower cost of goods sold, the company has higher net income, and that higher net income ends in a larger tax payment. So a liquidation is something that a company would definitely want to avoid. And the problem arises that if a company goes and does LIFO based on specific units, then a liquidation could actually happen very often. If you just think back to this example that we had, right, where we were doing this question for Swift Company. If you look at the LIFO ending inventory for this company, now granted it's just, two amounts, but there are two layers of old inventory here. So, this company is using units, and as a result, if it sells any of these items, it's actually going to be selling the older units at a cheaper price, and it would result in a lower cost of goods sold. So what does this mean for us? Well, what we need to understand is that because of the risk of LIFO liquidation, companies actually, instead of using specific units and specific goods in their LIFO calculations, they sometimes pool items together. Now, let me give you a practical example. Let's say I'm Paragon Sports, right? And I sell all types of sporting equipment. Instead of, for instance, just having my snowboards as one type of inventory item where I just track my snowboards based on the units of snowboards and maybe run into a liquidation problem, I will pool together snowboards and skis, maybe even skateboards and other items like maybe ski poles, ski boots. I'll make them into a pool of items so that instead of just following snowboards, and if I sell too many snowboards, I end up in a liquidation. I actually just use other units to assume that they were sold. So I actually make a bigger number of units, and this helps to alleviate the liquidation problem. So we throw them all together. Another example would be if I'm B&H, instead of just having phones as one type of inventory that I calculate my LIFO cost of goods sold and ending inventory for, I can pool together phones and tablets and computers, and so I can track the inventory based on a pool of goods instead of just one good. So you may say, well, what's the point? It sounds kind of like more work. Well, actually, what's nice is, let's say phones are really popular this month and I sell most of my phones. Instead of going into LIFO liquidation, I can use my tablet and other computer inventory to make up the numbers so that I don't actually end up liquidating earlier layers of LIFO inventory. So pools are beneficial. However, despite the benefits of pools, companies still sometimes have problems with these pools because they have to redefine them. What that means is that, yes, this year it may be useful to put phones and computers and tablets in one pool, but next year, some other items may come up, some new technology comes about, and suddenly I kind of have to define or rework the pool so that the pool still makes sense. So yes, a LIFO pool might be something that can help with this liquidation issue, but another option, and this is the option that we'll be dealing with in this video, is to employ something called dollar value LIFO. So here, instead of tracking the units of inventory under LIFO and multiplying them out by unit cost, we actually use a dollar amount, and that's the amount that we are tracking. So you may say, well, what does that look like? So let's go back to this idea of phones and tablets and computers. Instead of saying I have 10 inventory units of phones and 20 units of tablets and 50 units of computers, I instead say that I have $100,000 worth of inventory, and as I sell the inventory, I calculate what's left based on dollar amounts instead of the number of units. And what this helps to do is to eliminate the chance of us selling so many units that we end up liquidating again some type of inventory. Instead, we are always replenishing because we are working with dollar amounts, so we run a much smaller risk of going into LIFO liquidation. And again, you may be sitting there and saying, well, LIFO liquidation, big deal. But remember, companies save sometimes billions of dollars by using LIFO instead of other methods, billions of dollars in taxes they save. So if they do run into a liquidation problem, they could end up having a massive tax bill, which they will have to pay over to the IRS. And since this is a cost flow assumption, a company will be really disappointed to end up with a tax bill, since if they're using LIFO, there are other ways like the pooling method or the dollar value LIFO method to avoid liquidation. So, let that simmer for a while, and what we'll actually do now is go into an example to see how this concept of dollar value LIFO works. And so I am looking at example number 2 on your handout, and the page number for example 2 is page 11. And it says that XYZ company uses the dollar value LIFO method of computing or calculating its inventory. Data for the past 4 years follow, and our instructions are to compute or calculate the ending inventory for, not sure why this says ABC, it should be XYZ company for 2011 through 2014 using dollar value LIFO. So let's look at how we do this. So the beginning year is 2011, and the final year for which calculations are needed is 2014. So let's think about what we have been given here. We have an ending inventory number at current cost. Current cost means the cost of inventory in that year given any increases in prices over the course of the year. So there's 80,000 for 2011, 111,300 for 2012, and so on. We also get given a price index. Price index is trying to show the rate at which prices increase, but we need a base year from which to count the increase. So 2011 will be our base year, and therefore for that year the prices are at 100 or 100%. Whereas with 2012 we see 105 or 1.05 or 105%. What this means is that prices have increased by 5% between 2011 and 2012. In 2013, the price index, is 120. That means that prices have increased by 20% between 2011 and 2013. You're always referring back to the base year or the first year. And then in 2014, the price index is 130, which means prices have gone up by 30% between 2011 and 2014, which is quite a substantial increase. Now remember, we are trying to calculate ending inventory using dollar value LIFO. And so you might say, well, there's already an ending inventory number here. That's correct, but we have to account for the fact that there's inflation, and we also have to account for the fact that LIFO always assumes that the earliest years of inventory are left behind. So we can't just assume that this number is from 2012. It may even be from part of it may be from 2011. So what are we trying to accomplish? We're trying to see what the ending inventory will be under the dollar value LIFO method, and to do that we have to see which years this ending inventory number comes from. So the easiest way to figure this out is actually just to do it, because if we just keep talking about it, we may become somewhat confused. So there's a method to this. The first step in the method is to what we call restate inventory at base year cost. 2011 is the base year, so when we are doing 2011 restatement, there is no restatement required, but as we go through 2012 through 2014, you'll see that we will have to restate. Okay, so this is the first step, and the way we do that is to take the ending inventory amount and to multiply it by 100 divided by the base year index, divided by the index for the applicable year. You can see that it's going to give you 80,000 because there's no restatement necessary for the base year cost. So what this is telling us is that the full inventory, ending inventory, is coming from 2011. Okay, so this is the 2011 layer, and ending inventory under LIFO for this year is still 80,000. Okay, so ending inventory equals 80,000. So now you might say, well, what was the point of that? It seems like we just came to the same answer all the time. Remember, this is the base year, so nothing is going to be adjusted in this year. So just be patient. We'll soon see how this method is going to flow in 2012. So in 2012, we notice when we count our inventory at the end of the year that we have $111,300 worth of inventory, and prices have increased by 5% over the course of the year. Now we might just say, oh well, that must mean that ending inventory is 111,300, but the problem is that most likely in this number is included the 80,000 of ending inventory from 2011. The reason I say that is, remember, LIFO assumes that the oldest inventory is still left behind. So what's happened here is that because prices have gone up, we will have to adjust to see how much is this amount if we restate it at the base year cost. So we are going to take the 111,300 and multiply it by 100 over 105 to see what the inventory amount is. So we come up with 106,000. This means that if this had been the inventory in 2011, the amount would have come to 106,000. So now we know, given that LIFO always assumes that the earliest inventory is left behind, we know that of this 106,000, 80,000 is going to relate to 2011. It's a 2011 layer of inventory, okay, which will also still be at 80,000 because that's the base year. And then we have 106 and 80,000 is accounted for, which must mean that 26,000 is a layer that was created in 2012. So we've actually increased our inventory, which we kind of knew because 111 is a fairly high number compared to what we started with. So this 26,000 is stated at 2011 prices, but the layer was formed in 2012. So we actually need to increase the price to 2012 prices. So we're basically taking the inflation out and then putting it back in again to the piece of the inventory that applies to this year. So our ending inventory amount under dollar value LIFO is going to equal 107,300 when we add these two numbers together. So just take a moment here, rest, relax, think about this, right? You're working at a company, they tell you at the end of the year after doing the count, we have ending inventory of 111,300. You're not tracking the units, so you don't know or you can't tell which units are left behind. But what you do know is that you need to separate the inventory out based on when that inventory actually originated. We know based on LIFO that we assume that the earliest units are still left because we don't want to liquidate those units given that it will result in a high tax bill. So we need to figure out, right? If prices had not gone up in 2012, how much inventory would we have had at the end of the year? We would have had 106,000, right? So of that 106,000, 80,000 is a layer of inventory that already existed in 2011, which must mean that 26,000 is a new layer of inventory. And so that since that layer belongs to 2012, we have to restate it at 2012 prices. So in the end, we now know that our ending inventory instead of 111,300 is actually 107,300. And so the process continues. In 2013, we're told that we have $108,000 of inventory in 2013 prices. Do you notice that this number is slightly lower? So we must have actually liquidated some portion of our previous inventory. But let's see how the numbers shake out. So we're going to take the 108,000 and we're going to restate it in 2011 prices, which tells us that there is $90,000 of inventory in 2011 prices. Remember, LIFO assumes that the earliest inventory remains behind. So of this 90,000, it must mean that the 80,000 2011 layer is still there. And then we've got 10,000 which is not from 2013 because remember we had 26,000 from 2012. This 10,000 is still from 2012. So this company actually managed to sell 16,000 of the 2012 layer, but they still have 10,000 left. So they haven't liquidated the entire thing. So 80,000 remains. We don't have to restate it because it's from the base year. And then the 10,000 we are going to restate to 2013 prices. So you're going to write it back up to 120. So that gives you, oh, my mistake. Let's start again. So 80,000 remains at 80,000. The 10,000 was created in 2012, so I'm making a very, very easy mistake to make. I tried to write it to 120, but it should actually be written up to 105. So 10,000 times 105 over 100. Now you may be asking, first of all, wait, why did you make a mistake? Aren't you perfect? No, I'm not, right? So I made a mistake, but this is the correct answer. So where did this come from? Well, since this $10,000 is a layer that was created in 2012, we have to use the 2012 price index when we restate the ending inventory at dollar value LIFO. 80,000 was created in 2011, so the price index is just the base price, so we don't have to do anything to this number. So now our ending inventory is going to equal 90,500. So let's look at 2014 and see what's happening there, right? So in 2014, we have 128,700 of inventory at 2014 prices, and prices had gone up by 100 and or gone up to 130, so by 30%. Let me freeze the pane here so that we can still see the headings as we go through. So we restate this amount, right, to base year prices. And so it tells us that we have 99,000 of inventory. So it must mean that we actually created some extra inventory, because remember the last time we only had 90,000. So again, bearing the LIFO rules in mind, 80,000 of this must still be the 2011 layer, right? And then what do we think? Well, let's think clearly now. After the 80,000, we still have 10,000. So that 10,000 2012 layer must still exist. And then that's only 90, so there must be a new layer, right? A new layer, 9,000, is going to be not the 2013 but the 2014 layer. So in 2014 we actually created an extra layer of inventory. So now we've got 80,000, and the 10,000 we have to write up to the prices in the year when it was created, which is 2012. So we're going to do 105 over 100, right? It should come out to exactly the same as before, which it does. And then the 9,000 was created in 2014. So what we're going to do is 9,000 is going to be inflated to 2014 prices, so it's going to be 130 over 100, so that's 11,700. So our ending inventory in this case is going to be the 80,000 from 2011, the 10,000 from 2012, and the 9,000 from 2014. And once we inflate these numbers, you've got 80,000 plus 10,500 plus 11,700, which is going to be 102,200. And so instead of having a LIFO ending inventory of 128,700, because this has inflation built into it, the correct inventory amount under dollar value LIFO is 102,200. So we've actually managed to survive the dollar value LIFO approach, right? It's not so bad after all. But let's just think back now to what we were doing and why we were doing it. Remember, companies often track LIFO based on the units of inventory, but this can lead to liquidation, right? Because if you track units and you sell so many of the units, then you are kind of left hanging, and if you do liquidate your LIFO inventory, you're probably going to be faced with a big tax bill. So a second option is for companies to create pools of inventory where they combine different inventory together and say, hey, let's put phones and tablets and computers into one pool. The pools work okay, but the problem with the pool is that as the inventory changes, the company also has to go and redefine the pools, which can then mess up some of the layers from previous years and so on. So a good workaround is to use dollar value LIFO. This ending inventory would include all types of inventory units. It may be all the inventory that the company has, and they don't have to specifically classify whether it's phones, tablets, or computers. They just work with a dollar amount. But the wrinkle in all of this is because we are working with money, there's the problem of inflation. And so when we are trying to figure out which inventory is left behind, we can't just assume that 111,300 was all created in 2012, because LIFO assumes that the earliest inventory is still remaining. So we actually have to find a base year and restate all of our inventory in terms of that base year, and then figure out how much of the base year inventory is left and how many new layers were created. And the new layers will be then inflated to match the price index in the year in which they were created. So now you can go ahead and practice example 1 following the same methodology that we've been using in this question. Good luck.